Hey everybody, my name is Kenneth, and if you follow me on TikTok at Trade Invest Simplify, you know that the majority of my videos are about stock trading, but I'm also a long-term investor as well. And if you've been paying attention to the markets a lot lately, you know they're heading down. It's a great opportunity to start, not go all in, but start building positions in companies you really like. So, one of my biggest questions that I get asked is I want to make X amount in dividends per year at some point. How much would I need? What would my portfolio look like? Can you give us an example? I don't know you. I don't know your personal situation. I don't know what your rent or mortgage or your debts, or if you have kids, or if you have elderly parents or pets that you're taking care of, or car payments. I don't know any of that. I don't know how old you are. I don't know your risk tolerance. I don't know if you have 401k or a Roth IRA. I don't know any of this stuff. So this is just a portion of a portfolio that would be your dividend aspect of your diversified portfolio. So ideally, you also have some growth stocks, especially if you're young, because you have the long time horizon. You can have growth stocks if you're old as well, but maybe you have less in them because there's a chance, right? Like, let's say you buy Peloton. You've been crushed. Peloton's getting crushed. It's hammered. Uh, if you're young and you believe in the company, you think maybe they have a chance of recovery and you've got a long time horizon. And if you're wrong and you have a diversified portfolio, who really cares? Because your diversified portfolio will insulate you, right? So you can get crushed on Peloton, but you're still maybe going to be up because you have quality investments, dividend stocks, and stuff like that. Or your whole portfolio might be down right now if you're very heavily invested in all tech, for example, and you don't have companies like Coke, McDonald's, which are they insulate your portfolio because they're not down as much, or in some cases they're actually up. Coke was up for a period of the year. I don't know if they're still up, but anyway, this is the dividend side of the portfolio. It is not meant to be purchased all at once, right? So all these numbers change, right? Stocks go up, stocks go down. This is just an example portfolio of what it would look like to make $24,000 a year from your dividends. If you want more, right? If you want to double it, then you would have to double the amount of shares. If you wanted less, not that you would want less, but if you were starting out right now, you're very young and you're starting out, then you would buy obviously fewer shares. The idea with this one is that it is a diversified portfolio. It's got some food, it's got some oil and gas, it's got telecom, tech, pharmaceuticals, automotive. It's got a little bit of a lot of things. And if something is missing from this, remember, just an example. Before you read this and go, "There's no banking, there's no," chill. This is just an example portfolio. So let's get into it because I want to keep this video kind of brief. 1,300 shares of Cisco pulls you in about $2,000 a year. 781 shares of Verizon pulls you in about $2,000 a year. 2,500, almost 2,600 shares of Store, which is a real estate investment trust. They invest in retail, would bring in $4,000 a year. I like Store because Warren Buffett just purchased a while ago a 9% stake in this company. This is the Schwab High Paying Dividend ETF fund, 823 shares, pulls you in $2,000 a year. CVX is Chevron, 176 shares, $1,000 a year in the dividend. 1,250 shares of Pfizer pulls you in $2,000 a year. Johnson & Johnson, 221 shares, $1,000 a year. Ford, I went a little heavy because they just raised their dividend, and I personally believe in Ford long term. I think they're going to do great things with their electric vehicle sector. 5,000 shares, $3,000. 1,111 shares of Mo or Altria. That's big tobacco. So if you have a problem with big tobacco, I understand. But their dividend is 8%, and it's a solid dividend. $4,000 a year. Pepsi is the last one on the list. 434 shares, $2,000 a year. Brings you in $24,000 a year in dividends. Not to mention that assets appreciate, right? People always focus on the dividend in these videos that I make. And they go, "Oh, it'll take me 50 years to pay back the dividend or pay back my investment." That's the wrong way to look at it. These stocks appreciate in value too. Maybe not every year consistently, but the big picture. Think about big picture here. We're investing for the next 30, 40 years. You get the idea? Who cares if it's down this year? That's not the point. In fact, if it's a company that's really solid and you really believe in it and it's down this year, maybe you go a little heavier in that position. Sorry, my chair kind of creaks. And you can see that this diversified portfolio that has a list of different stocks plus 2 index funds pulls in $550,000 a year. This is not considering that you might have stock in growth in tech in an S&P 500 index fund as well. This is just the dividend portion. Costs 550 grand. And like I said, if you want more, you double it. You want less, you cut it in half. Next on the list is the index fund playlist. This is for the person who wants a diversified portfolio of index funds. They don't want individual stocks. Now you'll note that this is considerably more expensive. So here we have Noble, which is a Dividend Aristocrat ETF. They invest in all of these Dividend Aristocrat companies. A Dividend Aristocrat is a company that has consistently raised their dividend for 25 years or more. A Dividend King, 50 years or more. So Noble focuses on aristocrat stocks. It pays around a 2% dividend. I had to add it because I forgot to write it. And this one's going to cost you a little bit more, this portfolio. 3,300 shares, 300 grand. It's going to pull in 6 grand a year in dividends. Next on the list is a repeat from the last one. It's the Schwab High Dividend Paying ETF. They pay 3.3%. 2,400 shares will cost you $187,000, and it'll pull in 6 grand. Next up on the list, I went heavy because I think that for many people, this is my personal opinion, your heaviest investment should be a broad market index fund. That's because a lot of people are going to pick stocks incorrectly. They're going to pick the wrong growth stocks. They're going to pick the wrong tech. They're going to pick the wrong dividend paying companies, right? Because they're going to look at the highest yield and they're going to go, wow. And then they're going to get wrecked because high yield stocks are usually unsustainable. So if you're going to be reckless with your investments or you don't really know what you're doing, play it the most safe or the safest with the index funds, the broad market guys, VOO, SPY, SPLG. They're all the same, so you don't need 3 of them, just one. I put SPLG on the list because it's the one that I own. It's going to cost you $409,000. They have a 1.5% yield, and it's going to bring in 6 grand. Last up on the list is Realty Income. It's a monthly dividend-paying stock. It's a favorite on social media. People love this guy. You're going to grab 2,020 shares. They have a 4.35% yield. It's going to cost you 143 grand. It's going to bring in 6 grand a year. That hits your $24,000 goal, and it's going to cost you a little bit more than $1 million, right? So the index fund only route is already basically double the diversified portfolio route. Personal choice, obviously, but you can see it spelled out here. This is going to be way more expensive. Now, some people might argue that it's going to be safer because you're in, they handle the diversity for you because the funds are so diverse. But it's more expensive, and I like the individual stock side as well because it allows me to sell off losers, add winners, and rebalance my portfolio over the years as I see fit because I like to be involved. I like to pick my own stocks. The last one on the list is for the investor who doesn't want to deal with anything. They want one index fund, they want to add to it, and they don't want to be bothered. So with that being said, this is what it looks like if you only have one investment. So here we go with SPLG. If you only bought an S&P 500 index fund, you would put in $1.5 million roughly, right? Because remember, the prices go up and down. And you would make 24 grand a year from the dividend in SPLG up until you're retired and you're taking that money out. That 24 grand ideally should be going back into the index fund and through something called DRIP, Dividend Reinvestment Plan, building your portfolio larger and larger. So you might in fact have more than 33,000 shares. Next one up on the list is the Schwab High Paying Dividend Fund. It's going to cost you $730,000. And you're going to get almost 10,000 shares. Same stock market's open. It's going to cost you the same amount. It's going to, sorry, I got confused when the opening bell went off. If you're reinvesting your dividends, you're going to end up potentially with more than 9,800 shares over the lifetime, assuming you bought this all at once, which I know most people don't do. Last one on the list is Realty Income. That's the one that we talked about in the last video. and it would cost you $500,000, a little bit more. You would get 8,080 shares, and you'd make $24,000 plus the appreciation of the fund itself. So which do you think is the better option as an investor and most affordable, right? So you look at the first one and you go, dude, look at this, $75,000 in Ford, $77,000 in Pepsi. I can't afford this. 33 grand in Verizon. But the idea is that slowly over time, this is a mock portfolio. It's an example to show you. Let's say you've been investing your whole life and you're in your 40s or 50s today, and you've been slowly adding to your portfolio over the years. You could have something like this. This is $500,000. This is $1 million, this portfolio. And here, you're diversified because the funds are diversified, but your portfolio isn't. It just has the one guy. Look how much this costs you. For the same amount of money that you could get 10 stocks or 8 stocks and 2 funds for $550,000, you're only getting the one thing here. If real estate takes a hit, if retail takes a hit, if Amazon takes over and CVS doesn't exist anymore and AMC doesn't exist anymore, and all these companies that use Realty Income or that Realty Income invests in, Realty Income takes a hit. I prefer the diversified portfolio. Sound off in the comments below. Let me know what you think. Add your favorite companies, right? Because these aren't even my favorite. This is just a portfolio I came up with. So tell me what you like. Tell me what you don't like. Let me know in the comments. Thanks for watching. Hit the bell, hit the subscribe. Thanks for watching, and have a good day.